I'm trying to get that song. I'm gonna make a song. For some reason, I like that beat. I hope, please, whoever has a copyright, I think I got it from Google, so just don't, please don't sue us. We're giving compliments to the song here. So I will play it again, but I don't want to interrupt the show. But everyone, welcome back. I appreciate it. Today is Monday, so so that's what we're doing, is we're doing another live stream. Typically, we'll do it on Tuesdays. We'll test out to kind of jump it up this week, because I had looked through my schedule for educational content that I had planned for the year, and it's just so much of it that each week, or I'm going to try to add and sprinkle more on. So we kind of, because we've been getting such demand from it. The book has been a very good success. So I appreciate all you guys who have got yourself a copy. So this is kind of in tandem to the book, so we can be able to kind of fill in all of those frequently asked questions and all of those stuff that will help you make better decisions, either buying, selling, or investing in net lease. So today's agenda, obviously, we're going to go in the same order as we do every week. Cover the cap rates, Treasury, what does it mean? A couple top stories, what I think is important to take a look at moving forward, just to kind of keep an eye on. Our educational segment today is how to underwrite a NNN property in today's market, because again, that's a real huge sticking point. And again, this is just a piece of the piece of the piece. We're just kind of stacking layers until you have a good understanding and feel more comfortable when you're ready to take action. We got a couple frequently asked questions. Anyone who happens to be on live that just have a question, want to drop it in the chat. We'd love to take a look at it and interact with you. We did get 5 from kind of our ongoing list, and we'll just kind of cover that, which are in relation to kind of the news sectors of the week. And at the end, like I said, I have a free gift, which is an ebook to offer you guys that I can send off after the call, as well as the bonus for anyone who picked up the book. That will shoot me an email, and I can add you to our specialized list of kind of extra bonuses that we do throughout the week. So to kick things off, on our screen, I'm not going in any particular order. Normally I have the cap rates on here, but they kind of go hand in hand. Is a 10-year Treasury, as we've been kind of seeing lately in the news. Treasury has been up and down, but now we've been seeing it up. I know recently we had a downgrade of the United States credit going from, I think, AAA to A lowercase AA, something of that sort. So don't quote me on that, but it trickled down. This is not something new. It went down 2 times previous before in like the last, I think, 15, 20 years. So it's going to be mixed reactions online as well as the pundits. But Moody's had reference, Rich has been a writing on the wall for, the last decade, or, since, we've been tracking this thing, is the debt. So we have a huge amount of debt. Our Treasury Secretary had alluded to this on some of the Sunday shows, that it's kind of been, that's been in the works. So there's nothing that is going to be too surprising. So obviously we get a reaction from the Treasury adjusting for that. How investors are reacting to it is mixed. But again, as it relates to net lease, as me and Quinn was talking about before recording, is this has an impact on borrowing ability, because this will weigh in as a benchmark for interest rates, which then affects your interest rate going in, and your overall valuations as cap rates eventually rise, which then will shrink the valuation of the net lease properties. So going to the part with the presentation, which I'll get to that point when we get there, we're going to kind of go in deeper on some points for us to take a look at, just so we're more on track to be in a better position rather than be kind of completely surprised. So moving on to the cap rates, and then where's my notes? So we've added in like another 100 cap rates, and we've just been kind of as like a bird's eye view looking down. Not much has changed from last week to this week. And again, normally most brokers or research firms will put on a quarterly basis because then you can really see the huge spread. But again, we have a lot of active buyers in our database, and they kind of like to see the updated data as we come along, just so when they're making quick decisions through a 1031 or purchasing through financing, they kind of have an opportunity to see where we're at so they can be a little bit more engaged with their offers and the pricing on when we look to sell. So not much change, average 5.77 down to 5.75, and like I said, we're tracking like the average lease term 8+ years, but we have an average in our tracking, around 12 to 13 years. So like I said, we're on point there. And the reason I kind of put that together with the Treasury, because again, everyone's looking at that spread of where we're at with the Treasury and where we're at with cap rates. So let me see here. Is on your screen, Quinn, the cap rates?
Yeah.
Okay. Or is this Treasury thing on there?
Yeah, no, it's the cap rates. Yeah.
Okay, perfect. I just want to make sure. So then, all right, perfect. So, and again, anyone who wants this report, just shoot us an email. Again, this comes on every Monday. So if you have any friends or any other investors that you know that you can refer us over to, send them this report. We produce this every Monday, and then we do presentations, which kind of what I had alluded to going into this is we're going to be streaming a lot more. So we're going to be presenting a lot more data as far as like news that pertain to net lease investors, things that we find very interesting to kind of give you guys, some more additional information, and just kind of give the opportunity for everyone who wants to jump on and chat with us and ask questions and see what's going on with the net lease world. And we encourage anyone and everyone share the link and see if we can kind of get this show a little bit more spread out and kind of keep it moving. So that's where we're at with cap rates. So again, there's not much change there, and like I said, I like to review that in tandem with the Treasury. So from last week, I think based off my notes, 4.78 was the 10-year last year, and then today is 4.81. And like I said, it's going to be, as predicted, to probably trickle up even more, and then we're going to see ramifications, positive or negative, on the net lease market, and we'll see how fast it adjusts. But as we was talking about all these different strategies last week, that your overall main strategy on why you buy and having an established buy box criteria is important going in, and not getting too overly emotional about so much news that's coming in because it's so rapid. We can't keep up. We had a whole bunch of activity that's coming out of the administration as far as overseas policies, trade deals, tariffs. And if you get caught up too much into it, Rich, again, it's important to be in the know. You may not even take no action. So the best we're trying to do is simplify it as best we can. And again, we're only human. So we're this is an interactive and continuously moving target. So just be cautious with that, so we can double check the data and then make sure that we have the right strategy moving forward, which is the main point. So again, if you have any specifics as far as tenants or sectors, just let us know, and then we'll shoot you an information package, and then we can have a discussion on any strategy that you like. Next, a couple headlines in the news that I found interesting. And again, we kind of covered this, but like also got some emails about this, was the interest rate and how the valuation loss and what does that mean moving forward. Again, it still doesn't undermine the main strategy is to properly underwrite. And then when you see in this presentation where we're talking about kind of putting some, I put quote unquote buffer or some insulation is important. So then you'll be able to be in a good position wherever the market goes. So obviously we see some news indications of some positive impact, which then will benefit you greatly on the ownership side. but it's good to kind of know both sides and then put yourself in a position where you kind of have a little bit of insulation, not guaranteed, but a little bit of insulation based off of best practices. Um, we see here, retail credit watch. So depending on sector, and we talked about that a couple streams ago about some of the looming financial issues with certain tenants and bankruptcies, especially like Rite Aid and some of these type of retailers, and then also the retailers that may have had um, some vulnerabilities due to supply chain. So companies that weigh heavily on overseas while there is continuous negotiation simultaneously with multiple governments all over the world, and depending where this company is relying on their business model of goods overseas, that can have a high impact. So there's a news story with Walmart saying that they're going to make an announcement to their customers that they're going to be raising prices and referencing tariffs. And depending on what side of the fence, there's information coming in saying that Walmart had a good profit margin based off their latest financial readings. So as a company that was doing well, and then also you have on the flip side is where is a lot of their supply chain coming from, and then of course there's not just that simplistic look, but there's stuff that's coming in as far as how the economy is looking in the future, and if they're just pre-planning that to make sure that they kind of do as well as they can as a business. So Walmart obviously is a big case study because they're one of the largest employers and retailers in the country. So we want to make sure that if they're making such statements, we want to make sure we're kind of playing a close eye, because other companies that are in related spaces or a little bit close as far as business model, you're going to see kind of the effects on those as well, because we're talking about the largest retailer. So it's something to look at and just kind of keep an eye on. The REIT story is a really good, interesting one, where now they account for about 38% of acquisitions. So people are hearing that and say, well, man, I'm trying to get in. How am I going to get opportunities? Again, we got thousands of people on the list, and then they're saying, are we either picking from scraps, or is really any ample opportunity? REITs, as everyone knows, publicly traded investment firms that get public money, essentially have unlimited capital resources and the ability to close all cash and quickly. So we want to make sure that obviously if you're competing with that and trying to find deals, but REITs, they have essentially a target acquisition number each year. They may specialize in certain markets or specialize in certain sectors. So for us, again, is going back and finding out what is our game plan, what is our buy box criteria, and does it equate to what your plan is? And again, people kind of find it funny how I always relate this to life, is that you have 4 buckets in your life. You have your body, which are physical health, nutrition. We have our being, kind of our inner connection with ourselves, a higher being. We have balance. We have connection with our family, friends, loved ones, and then your legacy, which is the real estate side. All of the decisions that we make to make sure that we have we're paving the path moving forward. So if you have that in line, and then you put a number around that, either as a financial freedom number or a retirement number, or a goal to provide X to your heirs, to get out of a certain sector, so that now you have free up time and now you can be on the beach, you can take those vacations. I mean, at the end of the day, that's really why we are getting into real estate. It's just a tool. No one goes, and then nobody I knows is saying, I just love crunching numbers all day just for no reason. I mean, it's really for a purpose. And us real estate investors, we get kind of convoluted in the discussion of, we're doing all this stuff and we love real estate. But yeah, we love the ability that it can provide a certain lifestyle for us. And as we get older, in the 40s and 50s and 60s, and you start to see health, and then you look at your life and say, all of that work, it is like, what did I accumulate out of that? For us is providing, good loving children that love us back, and then we'd be able to provide them with a certain lifestyle, or at least an easier path than we had. So that's why real estate is a good tool. I love net lease, especially essential retail net lease, is because this, when you have long contractual obligations with a tenant, and it's long term, and you have, a good sector, a good market, a good healthy tenant, all of the elements look in place, and you have to think about it. They call it mailbox money. Now you get to actually go out and do what you really want to do. So I always include all of that in the decision making, rather than just like looking anally at the numbers, because at the end of the day, it's just a tool that everyone's using. And you can be in any sector: rental, industrial, mixed use development, whatever your system that you use to get to your end goal. That's what it is. But again, we like this because of how it's structured, and then how people kind of navigate to this towards kind of, all right, what's next. So that covers that part. But as far as the cap this news story off in regards to the REITs, is have your plan, go early as possible, especially if you're in a 1031. Try to pursue as best as you can off market. Again, there's thousands of opportunities out there. So if you are working with a broker, you're working with us, give us your criteria, and let's stick to it. Or I mean, let's kind of stick to this um, range that we're looking for, so we can go out and pursue it, um, and then move it forward. So then that means you have to start establishing relationships, and getting out there and looking at stuff, and kind of being firm on that, so then people can go out and actually look to acquire that information. um, Also looking at secondary markets. So a lot of the REITs, they're looking at these large metros, the top 50 metros, so that they're heavily in those markets, and they seem to be pretty competitive. A lot of people are trying to get in there, and then cap rates are adjusting for that. But there are some good secondary markets out there. So we just have to look at the demographics and all of the real estate metrics to see if that actually makes sense. So keep an eye on that. And then again, part of the book, Net Lease Playbook, we talk about the buy box criteria and having that written down, sharing that with your team, your brokers, your attorneys, your all your people that has to be in place in order to make this as smooth as possible, and you to move it forward. So awesome. Let's move over to Quindu. And while I'm looking up the next topics, and I'm assuming there's no question that came in as of right now.
Yeah, no, not yet. I had a question, but we'll go over when you cover it in the PowerPoint for financing. So.
Okay, perfect. And then just a quick break. Again, anyone who haven't grabbed a copy, I appreciate everyone who already has done. We have this available on printed version and Kindle ebook version. So, but if you do grab a copy, shoot me an email. First, I want to congratulate you, and then also put you onto a specialized list where we kind of do kind of behind the scenes. This is the stuff when we're actually engaged with the client and an investor, and moving them forward towards the process of closing. And then we kind of do a lot of this stuff over the phone, just to give our second look, our take. Some of this stuff doesn't go over the head of your attorney, of course, and your mortgage lender and your advisor. But we said we like to give a second look, because again, this is the industry we specialize in, and we just want to give our honest take on it, and stuff that may be of interest, that your attorney may consider, to help this move as smoothly as possible. So again, that's dclark@americannetlease.com. Just shoot me an email. I'll make sure to throw you on that specialized list. And again, go to the link amazon.com and just grab yourself the Net Lease Playbook. So kind of back to, and let's actually, since we're here, let's go over a couple of these questions, and maybe either Quinn will drop it in here, or when we do the presentation at the end, and then we'll talk about the ebook that you guys can grab. for some additional reading, that would be quite helpful. So the first one, if prices are dropping, should I just wait? There's never a perfect time. So we hear this in all sectors. So it's a reoccurring question. It's not a stupid question, but it's just, and again, and I understand it. I'm empathetic of that because people are seeing so much stuff. They're saying they they don't want to make a mistake. But again, we want to be firm on your criteria, and again, that has to be in correlation with your end game of your body being balanced and legacy. So if all of those align, and then we add in all of our insulation mechanisms, which we'll cover in the presentation, you'll be in a a better position for success. Because again, us waiting for any type of, there's no perfect scenario. So so again, it really comes down to what's your game plan, and then kind of sticking with that. And of course, with nuance, to make sure that you have as much data, so that we're not actually doing something that we shouldn't be doing. And then again, that's the overall advice with any type of real estate that you're looking at. So are Walgreens and Dollar General still safe? Again, they're both investment grade, triple B tenants, and it really comes down to the overall dynamics of commercial real estate and real estate in general is location, location, location. But we add in some addition is the lease. What type of lease we're talking about? Walgreens are typically flat. They typically pay a higher rent per square foot because of the location of hard corner location, to get them that premium customer customer view of the street. Dollar General, they're all over. I mean, you can't drive by and not see a Dollar General. So again, it goes by specific locations. If any of them happen to report sales, if you're looking at the market, is it healthy? Is it in a a location where they're having a lot of vacancies? So there's a lot of nuances. But in general, those are still good tenants because they're in necessity-based industry. So you have Walgreens is in pharmacy and general overall goods, and you have Dollar General is dollar store products that also serves milk, butter, and cheese, which is a staples for people that always going to need those products, toilet tissue and things of that nature. So
And D, just to speak on that, I know a lot of investors I've spoken to as well, their big concern is when Dollar General stock had dropped. I think it was like 44% last year. And then also they also say like they're building a lot of them, so why would they want to invest in them, even though they're investment grade tenant? So could you just touch on that? Because I know that's like two of the major concerns when they look at Dollar Generals is they're building a lot, and then because their stock had dropped last year, a lot of them are scared of them as a tenant.
yeah, I mean, again, it's always come down to look at, because then Dollar General is there. I give them credit. They're a smart company, along with Walgreens, a lot of these larger entities to a degree. Them building out, to continue their market share across the country. We will have to see the numbers as far as how rapid development is. Sometimes, based off economic measures, they can pull back as far as the level of construction. But overall, they're still in general a good company. So in relating to talk about the stock dropping, again, it's like that with all of these different companies, and it's all based off of economic measures. So Dollar General in its sector is a discount retailer. So they have a market that pertains to people that are at a social economic area, but also serve people where if they're at a higher economic, if the market goes down in general as far as the economy, they're going to go to dollar price items. They're going to go for cheaper items. So I would just look at it in general from, is the company still solid? Obviously it is if it's credit grade, but then we're going to look heavily at the location, because there's always going to be a need for that. If there happen to be no Dollar General, there's going to be a Dollar Tree or another competitor that's going to take up that space in that specific market. So we got to get down in kind of the nuance. Obviously, when they see Dollar Generals popping up in very small towns, in general, as far as how we perceive net lease to be, quality asset for the investors that we deal with, we're looking at multi-tier approach where we're looking at a healthy demographic. Is it growing? Does the income support that area that will support the tenant? Is it a good tenant to market match? And then where in particular is that specific location? Does it has good traffic? Does it have a good ingress egress? Good signage? Is it a staple in the community? So there's a lot of things that you could look at to make sure like this store could be a success. And in all worst case scenario, can that be replaced with a comparable tenant at a specific rent to sale, at a specific rental rate in that specific market. So we just want to look at all factors and looking at it from a real estate play rather than saying, oh, Dollar General is tanking. But obviously that is something to look at and make sure that we're kind of monitoring it. But the short-term fluctuation doesn't concern me. It's just more overall, is the company have a solid business model that people need and is in good location for this specific location, so we can be able to make an assessment.
And just to piggyback off that as well, when Dollar General announces they're going to close 200 stores, I know that's a quite concern that a lot of investors have as well. From your knowledge, when you see those announcements, is it more or less, because I know you can get a brand new 15-year lease Dollar General compared to something that has 3 or 4 years left on. Obviously, it's a case-by-case basis, the locations that they're closing. But what would you advise to investors who see those headlines and then kind of freak out because they obviously like them as an overall tenant, but when they see the $200, $300 Dollar Generals are going to be closing, sometimes they get shied away and don't even want to look at them as a company anymore.
Yeah, and those are pertaining to the leases that are going to be running out or towards the end of its term. When you're looking at newer long-term leases, the good thing about these, and again, outside of huge bankruptcy, but if the lease is going to say there's going to be guaranteed for the entirety of that lease, Dollar General, Walgreens, they will, for the most part, keep to their word on that, to not break the bond of the lease. But they're pertaining to lower performing stores that they will be closing up eventually. And again, that goes for all tenants, and it could be like a AA tenant, like a 7-Eleven or CVS or Walgreens, unless you see some type of bankruptcy coming along that will shy you away from it. But if the real estate is good and we can see and we can look at the rental rates in the market, how that specific tenant can perform, the overall general market, does it have resale value to it? How old is the building? There's a lot of factors to it. So it's kind of not easy just to put into a quick nutshell. So it's going to be a case by case basis. But I just kind of caution investors just to look holistically at the market, that specific tenant in that specific market, and just take it from there. And then we can kind of backwards and then add in these different elements of potential risk and see if it outweighs the overall benefit of the investment. So that's why we want to make sure that we look at it from a case by case basis and not get too caught up in all of the headlines, because as quick as it'll say the stocks dropped and they closed a couple of stores, and then all of a sudden a year or two things can turn around, which we're starting to see news headlines that due to reduced spending, potential tax policies being enacted, 2017 jobs, Trump tax policy to be extended, it can really revolutionize the industry, the economy. It's going to take time, but that's why we want to look at the major fundamentals of these type of investments and make sure that they make sense overall. So how should I adjust my underwriting in this market? So we're going to cover that in the presentation. And again, we're just talking about just with any investment, any real estate property, you're going to have some type of buffer, which is either reserves or you just kind of underwrite it more aggressively. and then see if those numbers make sense and if it coincide with your overall, target number that you want, and then make it make sense on that standpoint, because there's really no way to play the market to find out where's the best time to the entry, and just underwriting it with aspiration that everything's going to always go well. We always going to do it for some type of insulation there. We covered this already in the kind of the news reports. Competing with REITs, it's just looking for off-market opportunities. And the advantage of working with an investment advisor is that we have built a lot of these relationships. We can make calls on your behalf and get access to these things, so then you can be able to review them to see if it makes sense for you. These REITs are getting sent tons of deals. They get their first looks. They get a whole bunch of opportunity. They're buying a whole bunch of them at the same time. So you just want to make sure that it gives you enough ample opportunity to review and see if these make sense. And again, looking at off market, looking at secondary markets to see if those make sense, and then building up those relationships so you make sure that you at least have a shot at them, especially if you're in a 1031 and you have time constraints, which can add on more stress and pressure onto the situation. Is now a good time to use a 1031 exchange? Again, it kind of relates to what we just said, was everything's a nuance, but you want to start as early as possible, as far as if you want to start looking at your exit, as far as if you're in the process of to list your property, or you already have the property listed and you're fielding offers, or you're getting close to the end and it's getting towards the end of escrow. You want to start looking as quickly as possible and start making offers, because again, all of those are non-binding agreements when you send out an LOI, and just give you as much ample time. So again, you want to make sure that on your sell side, you're selecting the time and opportunity to maximize the amount of resale that you can get from your asset, rather than the sale, thinking that you want to go secure something on the front end. It never works out that way. I mean, we had always these clients say, I don't know what time I want to list it, because I want to make sure I secure something. And then by the time we secure something, then someone don't want their it's always going to go something. And that's the name of the game of real estate and business and life. So I would just say, if you're going to pursue it, make sure you're prepared to get the maximum amount. Again, it's really about getting as much out of the exchange. So you want to make sure that whatever you're selling, you get the most amount of capital you can get out of it, so you can reinvest it. I mean, you worked hard for that equity, so get as much money out of it. So position to sell it for the maximum amount of dollars, which means putting it on at the time when you can feel the highest amount of profit from it. And then once you get ready to move that over to the replacement property, start working as early as possible to look at opportunities, or at least like we're doing now, doing market updates. So then what's going on with the cap rates, what's going on with the market, and then you can kind of decide on which tenant and sector you're interested in. So then we can kind of hyper focus on there and get an idea what the returns will be. Does that match with your expectations and your needs? So then we'd be able to have enough ample time to review as many of those, make offers if need be, get the certain response, because you may put yourself out there to get offers, to make offers, but then we may not get the reciprocal response that we want. So you want to make sure we're actually active and getting out there as quickly as possible, so we'll be able to have as much time if any issues come along. So if anyone who's live want to submit any questions while we're here, like I said, we just finished off about 5 questions. That's going to be kind of rolling into the next topic for the presentation. Love to hear from you, but again, we appreciate it. So if nothing, we're gonna, let me see what else I have in my notes. So that's good. We're in pace, a little longer than I expected, but we'll kind of get through this presentation in about like 5-10 minutes or less. So today we're going to talk about underwriting, which again pertains to the last month worth of lives that we're talking about the market. Everything is to be, let's talk about the numbers. we're at with Treasury, we're at the economy, we're at with interest rates, and how do we do this and how we do that. Again, we're just trying to put ourselves in a position that we feel comfortable on the buy side that meets our needs, body being balanced, legacy, and the legacy piece, which is into the future. So we're trying to put all that work in now, so then we have the opportunity to benefit from the real estate, especially if you're doing a 1031, the time, energy, effort, sweat equity, stresses, tenant calls, cleaning, fixing toilets, to then make that money to then put into a property that's going to last you, that you can pass on to heirs, pass on to family, and benefit and do what you want to do. So hitting off with the first slide, we talked about kind of the benchmark between the Treasury cap rate spread. So always have the updated information. So each day, this week, we're going to try to go a little bit more live, more frequent, so you can have that data. But it's always a good thing just to kind of keep your eye on these metrics, eye on where the mortgage rates are, if you're going to be planning on using some debt to get into it. And then we start modeling numbers that a little bit have some buffer in there, so then you can understand where you may fall into and then where you feel comfortable at. And again, that also, my last bullet point, that's pertaining to, because mind you, all of these properties, a lot of people are on the same tier as you. They all want a good deal. Everybody we talk to, I say, what do you want? They want everything everybody else wants. So again, you have to also keep in mind, as far as buyer competition in this, when we start essentially competing for investment opportunities that make sense. So that's why you have to kind of really dig down and think about, what do you really want and what do you don't want? And then hyper focus on that, and then let's put a number to it. So then we're more realistic, and then we're able to now tap into multiple opportunities rather than hyper focusing on one, and not putting us in a position where we're going to be either overpaying for a property, or getting into an opportunity that doesn't make sense and put us in potential risk in the future. So the tenant risk factors, as in we're looking at rent to sales ratios. So the tenants that do offer on their lease the review the sales numbers, we want to make sure that those coincide, that the store can support itself to pay rent and do well. I mean, we don't want it to be squeaking by, because we have long-term lease agreements. So we're not in it on a speculative basis where we're looking at from 1 year, they doing well, and then we're going to resell it. These typically going to be 10, 15-year relationships that you're going to be essentially, buddy with these tenants, and you want them to do well. At the same time, you want to get as much profit out of it, of course, but at the same time, you want to make sure that this is going long term. We get a lot of calls where they're talking about, we want an exorbitant amount of rent, and I'm like, it's going to be too much pressure. It's higher rent per square foot in that market, and any little hiccup, especially what we're seeing with the economy, and these companies won't be able to handle it. It's gonna turn them over. We also have to look at certain markets where we're looking at how much the wages in that market in comparison to other markets, and regulation and taxes. So those all is kind of a secondary conversation. We want to make sure that in general the store can support itself. On the flip side, we're talking about the investment grade tenants. We're talking about tenants that are tracked by Moody's and S&P, that they have a strong credit rating, that they can be able to kind of withstand. So that they are able to meet that rent obligation, even if the store is not up to par. They'll be able to support paying the rent each month. If it's a franchisee or a smaller corporate, you want to make sure that they're at least 2.5 before earnings, to make sure that number is in conjunction to support the store. The most important part is they pay your rent, and that's what we want to make sure. So each quarter we have a credit rating that we track, and we send those out. So coming January, February, March, so I guess the end of next month is when the next quarterly credit rating report. So once we start aggregating on that data, I think we have about 50 tenants, the major tenants on there. So then we'll be able to send that out, and just a good to review. And then I also I give a little tip of use Google Alerts, add in all of the tenants that you're interested in that are public traded, even some of the local brands, and just see what's going on. What are they talking about? Read some of the earnings reports, where they'll give you, what they're forecasting into the future, what their sentiment is coming from the customer base. They're following a lot of the policy in Washington, so you get an insight of it to see how these businesses are operating. So then, when you're ready to make a decision, you have better information and feel comfortable to move forward or not move forward. So that's always important. Real estate 101, location. So we always get the top 5-7 markets like Florida, Tennessee, North and South Carolina, Florida, Arizona, the kind of the bread and butter states. Why? Because they're landlord tenant, they're business friendly, favorable regulations and tax policy, and have a lot of drivers and metrics that draw businesses there, as well as people to relocate there. So like here in the state of Florida, we have an influx of people coming from all different states, and they're going to need food, they're going to need essential services. And then on top of that, we have no state tax, and we have favorable, reasonable regulations and taxes and things of that nature. So you want to have a combination of those, and then we track and say the census and seeing which other states, because there's also not just states, but also certain markets that are getting an influx of population. Universities, near federal stuff like military bases and things of that nature, to make sure that those are markets that are favorable to not just regular population, but businesses and the like. So we talk about the major metros. Obviously, you want to get into areas where it's a lot of people in that market, but we talked about the competition of the REITs and looking at secondary markets. So if you look at from a macro and micro perspective and just looking to make sure that there's we just want to be in a position where the tenant is in a good position to pay your rent and to also expand business and do well into the future. Avoid overbuilt retail corridors with poor foot traffic. And that's kind of just a given. I just want to make sure that everything that is optimized and not having an overabundance of, say, hair salons and barbershops. You just like a good collection where there's like a good synergy of tenants. I like to use the word synergy, especially if you're looking at, shopping centers. Is it part of an out parcel? Do they have too many burger spots where they're kind of cannibalizing each other? It's just a good synergy of different tenants, and they kind of feed off of each other, where, obviously they're in competition. You're not going to just have one, but it's a good, healthy mix of them that allows for a good ecosystem within that submarket. I appreciate it. The stream is it's kind of different from our niche. He's mentioning VA home loan for 4-family. So that's not my specialty. So I would probably refer you to people that specializes in multifamily. But I do appreciate the chime in with the comment. But we're talking about on the net lease side. It's it's commercial financing, but it's a different type of investment with this net lease structure. But I appreciate the comment. So analysis essential. So we talked about this 2 streams goes is making sure that it's actually a true triple net. So you'll get a lot of these packages, and maybe some of the sellers that you talk to directly will say, yeah, it's a triple net lease, and then you come to find out that you do have to replace the roof after $5,000, and actually it's a a reimbursement structure. So you really have to really dig into it to find that language where it really says that the tenant is responsible for these options. It's okay if there's an option if it isn't a reimbursement, if it's full reimbursement, but you just make sure that A, you're comfortable with that, and B, it says what the package says it is. And again, it's just taking the extra time to review it. And again, on the seller side, and I'm not trying to talk about anybody negative, but their job is to sell the investment for the client. Us, we represent the buyer and the investor, so our fiduciary responsibility is on your benefit. So we want to make sure that we will look at this to make sure that it's what of your expectations, and it's a clean deal moving forward. And then fine, what's that?
No, I was just gonna say I got a real live example of that. Working with a buyer right now. He's doing a 1031 exchange, and he was looking at it was a triple net coffee shop. And on the lease, on the OM, it says it's triple net, absolute no landlord responsibilities. But when you dig into the lease, it's part of a shopping center, so he's going to have like cam charges and whatnot. So he kind of just threw them off. So a lot of investors, they see it on the OM, as you mentioned. It says triple net, no landlord responsibilities. But once you dig into it, typically the seller is not going to tell you until you either already in contract. You're not, unless you have somebody like us who can see it ahead of time. But typically, like you said, if it's on the OM, it just says clean triple net lease. But then when you dig into it, it does have those.
Yeah, that does happen, especially the good point of the shopping centers, especially if it's brand new, where there's also association that's involved with it. So you have to make sure you're making sure you look at the underwriting, the underlining of the lease. In some cases, we may have the option to change that if you act early in the process. In some cases, it is what it is, and that's stuff that you have to deal with. So again, when we want to make sure as of expectations, as that we dig into it and then we confirm everything, trust but verify. And I verify times two, because you'll hear it. And again, you want to make sure that you put yourself in the position where you're not surprised and of success, and not having to come up with a bill at the end of the quarter. So again, that kind of covers the last point, is like, who handles what, HVAC, roof, taxes, and things like that. And you want to make sure and there's a small case study of the taxes. Sometimes Dollar Generals, they have a reimbursement structure. You can, in some cases, I was able to change it to have the bill sent directly to the tenant, and then they pay it directly. But normally, in that particular case, the owner will pay the taxes, send the bill over to the tenant, and then they get reimbursed within 30 days. But you want to make sure that that's spelled out and you're not surprised, and then all of the expectations is met on these deals. So this is the important piece here, is the exit plan sensitivity. So I tell all the investors to kind of plan ahead, especially now that we're being hypersensitive to what's going on in the news. So the best thing you could do is just do entry and exit plan sensitivity analysis, where you're kind of modeling where the investment will be in 5 years, and you're adding in 25 to 50 basis points on the exit cap. So now okay, this is where the number is going to be at, and then you're planning where if it's continuously cash flowing, and obviously most deals have a rent bump every 5 years, so you can comfortably add that. We would know that, of course, up front, because that's a contractual agreement that is built in. But we want to make sure that when we underwriting it with current, but a little bit of buffer as far as the interest rates, because things can change unless you get like a rate lock. But then you have a case of how long your lease is going for. So assuming you may do a 10-year lease, that you're underwriting the potential increase and then still cash flowing positively. You don't want to be in a scenario where you're coming up for a balloon and then interest rates rise, and then you have either forced to sell, or you lose the ability to pay your mortgage. So we're just trying to put ourselves in a position where we're not forced to do anything. The original purpose of buying the deal was to get cash flow, enjoy the benefits of the property, which meets the needs of a business, body being balance and legacy. So if those don't get disrupted, then like I said, that makes the plan work. So we make sure that we're adding those numbers on the front end and the back end and making sure the cash flow is in there. So then we're set up for success in the future. And that's it again. So again, we appreciate your time on this. Again, grab a copy of the book. It's on Amazon. We've been getting a lot of positive feedback from it. Yeah, give us a review as well. Let us know if there's stuff in the future. Well, I would prefer a positive review so more people buy the book. If you have any qualms with it, just give me a call and then say, hey, you're missing this from me. But I think it's a great book. It's about 10 years worth of dealing from bad deals to good deals, all the successes, all of the stuff I learned over the years from 1031 exchanges, large, small deals. It's all there from advice we got from attorneys, from lenders, from insurance people, from all different types of investors, from either a rental investor, highly experienced, a developer, first time, highly experienced. It's all in there for you, and is well structured, well written. And it also leads into a couple other points which pertains to our main sector of our life, syndications and 1031 exchanges for advanced strategy. So again, send me an email and I add you to the list if you want any of the bonus content. And I didn't upload that slide because I wanted to offer it. So what I'll do is I'll just send in the email whoever is on our list of our latest ebook on the investment or the presentation we just did for underwriting. So I'll just remember to add that in the link of this presentation. So once this is over, you can click the link, go grab the ebook. I just need your email. And also, if you want to talk to somebody about any specific strategies, upcoming buy, sell, or investment opportunities, let us know. And we'll love to have you. So if anything else, I don't think we have any more, no more comments. So I appreciate it again and look forward to catching you guys tomorrow. Let's try it again tomorrow. And I hope everyone enjoyed it. Have a great rest of the afternoon. Take care.